Welcome to Breaking News to Trading Moves.
Today we're looking at some recent material that really focuses on market reactions.
Specifically, reactions right after those geopolitical actions targeting energy producers.
That's right, we've got analysis centered on the U.S. Treasury sanctions against Russia's big oil producers.
And at the same time, the EU making moves on Russian liquefied natural gas, LNG.
Yeah, coordinated actions.
And the material points to a really immediate market signal, doesn't it, Brent crude?
It does, a jump of about $2 right after the news broke.
Which, tells you the market saw supply tightening instantly.
It's a pretty clear reaction.
Yeah.
And the why is straightforward, too. These moves aim squarely at Moscow's energy income.
So our task here is basically to trace how those actions, those constraints, end up helping some sectors and, well, hurting others.
Exactly.
Yeah.
We're just identifying those winners and losers based on the analysis we reviewed. No personal opinions, just what the material lays out.
Okay, let's dig into the sanctions first. Because it's not just a simple ban, is it? The U.S. targeted Rosneft and Lukoil specifically.
Correct. But the material really emphasizes the potential for secondary sanctions. That's where the added complexity comes in.
Secondary sanctions, right. So for listeners, that means the U.S. can penalize foreign banks, say, if they deal with these sanctioned Russian companies.
Precisely. They basically have to choose, do business with Rosneft or Lukoil, or keep access to the U.S. financial system.
Which is a huge deal.
Absolutely. It makes everyone involved in international trade banks, insurers, shippers, extremely wary of touching anything related to these sanctioned entities.
Even if the trade itself isn't directly under U.S. law.
That's the point. The risk is too high. So you see cargoes get rerouted, deals get halted, it adds friction and cost.
Okay, so that's the U.S. oil side. And then you layer on the EU banning Russian LNG imports.
Right, which tightens the global gas market and forces Europe to look elsewhere very quickly.
So putting it together, the mechanism seems to be tighter supply routes, maybe some product actually coming off the market, plus this increased compliance risk.
And that combines to push benchmark crude prices up and makes non-Russian supply more valuable.
Okay, that sets the scene pretty well. Let's talk about who benefits, the winners.
First up, the analysis points to U.S. upstream and integrated oil companies.
Right, the producers.
Yeah.
The logic being tighter global supply means higher prices for crude and also for refined products like gasoline and diesel.
Yeah, it provides better price support, and this directly helps domestic producers, especially those already geared towards oil price movements.
The material names Exxon Mobil, that's XOM, and Chevron, CVX.
Correct.
Now, quick question there. Aren't integrated companies like them sometimes hurt by higher crude costs on their refining side?
But that's a fair point. Rising crude can squeeze refining margins. But the analysis suggests, in this specific situation, the benefit to their production side, the E&P outweighs that. Well, they often have large, relatively low-cost production, especially domestically. And they're refining barrels from various sources, not just the expensive ones. So the gain from selling their own produced oil at higher prices, plus generally firm prices for the refined products they sell.
Yeah.
It tends to be a net positive when geopolitical risk pushes the whole oil price complex higher.
Okay, their integrated model gives them a bit of a cushion there. Makes sense. So category 2 for winners.
Oilfield services, SLB and HAL were mentioned. Schlumberger and Halliburton.
Ah, the companies that help the producers drill and maintain wells.
Exactly. It's a knock-on effect. When oil prices look like they'll stay elevated, they'll be more stable at a higher level.
Because of this geopolitical risk premium you mentioned.
Right. Producers feel more confident investing in more drilling, more maintenance.
Yeah.
Especially in places like North America, seen as reliable supply sources.
So even just a couple of dollars increase in Brent, sustained, can signal that it's not just a blip.
The analysis frames it less as a blip and more as the market pricing in ongoing risk. When sanctions get tougher, producers anticipate a higher baseline price for longer. That encourages spending.
Which means more business, better pricing power, and higher equipment utilization for the service companies like SLB and HAL.
Precisely.
Okay. And the third group of beneficiaries.
This one relates directly to that EU action, U.S. LNG and the midstream infrastructure. Think export facilities, pipelines.
Because Europe needs to replace that Russian gas, and the U.S. is positioned to supply a lot more LNG.
Exactly. There's a sudden structural increase in demand for U.S. LNG exports, especially heading to Europe. This heavily involves Gulf Coast infrastructure.
The material mentioned tolling economics being a key benefit here. Can you explain that?
Sure. So many of these big LNG infrastructure companies like Cheniere LNG or pipeline operators like Kinder Morgan, KMI, they don't just make money based on the fluctuating price of natural gas itself. They often operate under long-term contracts called tolling agreements. It's like reserving capacity. A buyer, maybe a European utility, pays a fee to reserve the ability to liquefy or transport a certain amount of gas through their facility.
Like paying a toll on a highway, whether you drive one car or 10 that day.
Kind of, yeah. They lock in these fees, often for years. So the sudden rush from Europe to secure non-Russian gas means more demand to sign these long-term, stable, fee-based contracts.
So it's not just about selling more gas today, it's about locking in predictable revenue streams for years to come.
Exactly. It benefits the volume, yes, but crucially, it solidifies those long-term fee-based economics. LNG and KMI were the names highlighted there.
Okay, that covers the winners pretty clearly. Let's shift gears now. Who faces pressure from this? The losers, so to speak.
Yeah, these are generally sectors where fuel's major operating cost. That $2 bump in Brent, if it sticks, can hit their margins pretty hard, especially if they can't easily pass the cost on.
First on the list, airlines. Seems obvious, right? Crude goes up, jet fuel goes up.
Directly. Jet fuel is often one of their biggest, if not the biggest, variable costs. So higher crude immediately pressures operating margins.
And the material brought up fare elasticity. What's the significance of that here?
Right. Elasticity just means how much demand changes when price changes. For airlines, especially on very competitive routes, demand can be quite elastic.
Meaning if they raise fares too much to cover fuel costs?
Passengers might just choose a cheaper competitor or maybe not fly at all. So they often have to absorb at least some of that fuel cost increase, which hurts their profitability. Their ability to pass on costs is limited.
Got it. The examples given were Delta, DAL, and American Airlines, AAL major carriers feeling that pinch.
Yep. Then following airlines, you have cruise lines and leisure travel.
Also travel also uses a lot of fuel.
A lot of fuel. Bunker fuel specifically for the ships. It's a huge chunk of their operating expenses.
Why are they particularly vulnerable? Don't they hedge fuel costs like airlines sometimes do?
They do hedge, but often maybe less extensively than major airlines, or their exposure is more directly tied to bunker fuel, which tracks crude oil quite closely. The analysis pointed out that this geopolitical risk premium keeps bunker prices elevated.
So even if it's peak season, like summer, when they should be making good money?
That persistently high fuel cost eats directly into their margins. It compresses their profitability during their most important earning periods. Royal Caribbean, RCL, and Carnival CCL were mentioned as examples facing that headwind.
Okay, one more category facing pressure. Chemicals and plastics. This seems less direct than travel.
It seems less direct, but their connection is through feedstocks. Many chemicals and plastics start with materials derived from crude oil, like naphtha.
So if crude oil gets more expensive.
Their primary raw material cost goes up, plus any disruption to trade routes can also increase their logistics costs for moving these materials around.
And the material talked about downstream product spreads narrowing. What does that mean?
The spread is just the difference between what they pay for their raw material, say naphtha, and the price they get for the finished chemical or plastic product they sell.
Okay.
When the raw material cost jumps up quickly, like with a crude rally, but they can't immediately raise the price of their finished product.
Because of competition or maybe existing contract?
Exactly. That price difference, the spread, gets squeezed. Their profit margin shrinks, at least temporarily, until they can adjust their own pricing.
So there's a lag effect that hurts them.
Yes. And companies mentioned here sensitive to this dynamic were Dow, DOW, and Landel, Bales, LYB.
So looking back at everything, it paints a picture where a single geopolitical event, like these sanctions, can pretty quickly translate into cost increases for some sectors and, well, revenue opportunities for others, based almost entirely on how exposed they are to energy prices and global supply chains.
Yeah, that dependency is key.
It really is. So maybe a final thought for you, the listener, reflecting on this material. It really highlights how deeply interconnected things are. Think about how much certain industries like chemicals, relying on naphtha,
are exposed to geopolitical tensions. Even if they have zero operations in the region causing the tension, their vulnerability comes purely from relying on an oil-linked global commodity chain.
That sensitivity, that supply chain exposure is definitely something to keep in mind.
A crucial takeaway.
And just to be clear, this is not financial advice or a recommendation to buy or sell. This information is purely the opinion of the author of the original material we reviewed.